Well, Happy New Year. This is Robert Gilliland coming to you live from the Concenture World headquarters right here in Houston, Texas. Actually coming to you today from our office. Very, very lucky. We did this last quarter, and we're going to continue to do this. Very, very fortunate to have the CIO with Chief Investment Officer for Sanctuary Wealth, Jeff Kilberg, on with us to kind of give us an outlook from 2022. Jeff, I got to say thank you. Clients loved hearing from you last quarter. Really looking forward to this quarter. Here. I got to tell you, I compliment you on the nice red jacket. It looks awesome. I wish I could pull something like that off. It looks good. I appreciate it.
Well, thanks, Robert. And the holidays are here, so I have to sport the jacket coming to you from Chicago. But what a year 2021 has been. I'm excited to unpack that a little bit, but also talk about 2022. So thrilled once again to be here with you and your clients. And if I don't get a chance to see everyone down in Texas, I wish everyone a happy holidays and a wonderful new year. And I'm pretty sure it's going to be a great 2022.
That's awesome. That's good. I think that's really a good starting point. Let's talk about, given what's happened in 2021, kind of what's your take? What's kind of the big takeaways from 2021?
Well, it was a really interesting year. And if we talk about interest rates, because everyone talks about interest rates because we're so sensitive, our economy is so sensitive to interest rates. A lot of people were very hawkish, meaning that they thought interest rates were going to go higher. If you look at the 10-year note, a lot of folks, a lot of the economists or so-called experts thought that the 10-year note was going to go over 2%. My view at the CIO suite was always that we were tethered to 1.5%. And by and large, Gilly, the reason we were tethered to 1.5% is because the Federal Reserve owns about 1/3 of all the 10-year notes out there. So of course they want to keep rates low. And sure enough, we're ending the year, we're at about 1.45% on this historic Fed week. But I think interest rates really dictated the market action. And you saw that rotation. We saw that grappling, that continual wrestling match between growth and value. With interest rates subdued, I think it really allowed that ebb and flow from growth to value, back to growth in the month of June. You saw that consistent, but high tide kind of lifted all boats. I think that was really indicative of the fact that interest rates stayed subdued.
You know, that's really a good point, because when we started the year off, we really thought the value was going to be the lead horse, right? And it did go up and down and kind of go through. So kind of given that backdrop and with some of the things that are kind of going on, what are you thinking 2022 is going to be like? Like, kind of what are some of the big things that's kind of front of mind for you?
Well, I think certainly you're going to have to be active. I think you're going to be dynamic, but understanding that battle between growth and value, I think that's really a big piece of the puzzle moving forward in 2022. If you look at some of these tangible blue chip names that were laggards in 2021, I think they find some love. I think they find some investor interest. So if it's talking about some of the industrial names like a Lockheed Martin or a Boeing, which has really had some rough, flights, pun intended. But look at some of those names where I think we get excited about some of the tangible names. But sectors, if you have the sectors right, I think that really helps you in being focused. And more importantly, having the sectors that aren't potentially participating, staying away from them. Let's just use energy, for example. 2020 was a pretty rough sledding for energy. 2021, that was the sector to own. So we get really particular about what sectors, specifically what stocks and what sectors we want to own. But I think 2022, again, you have to get the sectors right. And then we also talk about the actual weighting. As you know, Gilly, the S&P 500 is market weighted. What does that mean? Well, that means that the top 5 stocks, those FANG stocks, Facebook, Apple, Amazon, Microsoft, and Google, they represent about 25% of the S&P 500. So we like having some equal weighted exposure. We still want to own those growth stocks, but I think it's more important not to own them in such a concentrated way. So I think having some equal weighted undercurrents in your portfolio, owning the right sectors, and also understanding that the Federal Reserve's balance sheet, and we'll talk a little more about their balance sheet, but their balance sheet is so bloated, right, wrong, or indifferent. We're not here to debate the Federal Reserve and their intervention, but right, wrong, or indifferent, it's a $9 trillion. That's with a capital T, $9 trillion balance sheet. And we can talk about tapering, we can talk about interest rate hikes, but at the end of the day, I do not envision them unwinding or reducing that balance sheet. And that's why I'm optimistic and constructive on 2022.
What's interesting, you say the Fed. One of the things that, going back to the last time that we had a massive, really, that I remember that the Fed went through and did things was 1994. They raised rates 6 times, right? Basically what you're saying is that's probably not likely. We're not in another 1994 type period. Would that be fair?
It is, but we don't have a historic moment to really point to. Inflation is real. It's tangible. Here in Chicago, we're paying for more for food and energy. I know the government doesn't utilize food and energy in their inflation measurement, but look at me, Gilly. I like to eat, I like to drive my vehicles. So I think inflation is real, and I think they're going to have to be considerate on how they tame that inflation. Now, I am in the notion and in the camp that we've seen a lot of purchases. We're buying a lot of things as we kind of still get out of COVID. So I think that cools down. So I'm not saying by any means inflation's transitory. Prices are going up across the board, but I think inflation does cool in Q2. And that's why I'm in the camp that we're only going to see one interest rate hike. A lot of folks are talking 2, 3, potentially 4, but I just disagree. I don't think the Fed is going to stumble. They've been so dovish. All the pundits, all the folks on CNBC and all the business TV are talking about how hawkish Fed Chairman Powell is going to become in his new term. I just disagree. I push back. I'm not with the consensus on that. That's why I'm in the camp of just one interest rate hike in 2022.
By proxy, doing a little bit of the taper is a little bit of raising rates, right?
Well, yes and no. So the taper, which is simply reducing the amount they're purchasing. And remember, they're in historic purchase mode. Going back to March of 2020, when Fed Chairman Powell came out and articulated to the marketplace that we will be here in unlimited capacity and unlimited power, right. That's exactly what they did. So those $120 billion per month, it's hard to believe that 21 months later, they're still in that purchase mode, but nonetheless, they are. So now they've reduced, they announced that back in November, they're reducing it by $15 billion a month. We expect them to accelerate that or double that to $30 billion a month reduction. That's going to allow them to be done purchasing assets in a slow and prudent way, probably by March. Now that gives them optionality. We talk about optionality. Does that mean they're going to do it? Some pundits are saying yes, but it gives them the option to raise rates because they have to stop the purchases before they raise the rates. But I do think we're going to have to really measure inflation, growth. We're looking at all the different undercurrents. You're seeing a lot of companies in buybacks. So I think we have to wait to see in Q2 to see if that hawkish tilt, which simply means they want to raise rates quicker, I think that will come to fruition in Q2 of 2022. But I don't think they raise rates as strongly or quickly as a lot of markets pundits are forecasting.
I think that makes a tremendous amount of sense because most people, when they think of taper, they don't realize exactly that that's just, it's not that they're stopping supporting the bond market, they're just reducing what their investment is. And that point makes a lot of sense.
Yeah, if I could hammer that home just one more time. So it's a three-headed monster, right? We talk about the tapering, which is simply them walking away or exiting the party, which they created, of purchasing $120 billion a month. The second component, the second head of the monster, is raising interest rates. We've seen historically that they do need to raise interest rates to tame inflation. And remember, they've created this inflation, but nonetheless, that's threading the needle. I don't know if Fed Chairman Powell has the Tom Brady skill set of threading the needle, but nonetheless, that's the second head of the monster. The third component, which no one talks about except for me, is the fact that the Fed's balance sheet is $9 trillion. We can talk about pre-crisis going back to 2005, 2006. The Fed's balance sheet was $450 billion with the B as in boy. And now we've seen how they've dramatically expanded this balance sheet to support the economy. But I don't think the Fed has the ability to unwind and reduce the balance sheet, which is the third head of the monster, in my opinion, the most important, probably to 2024, 2025, if they ever have the ability to even reduce it, Gilly.
Right. So we got a long time in there. So kind of when you go through and you look, you said that security selection is going to be important. Being able to play the balance, be equal weighted, not overweighted or overly concentrated. What about international versus US? Is now a time with everything going on to start paying a little bit more attention internationally?
Well, that's a great question. I think absolutely you should have some exposure overseas. Look at the dollar index. I focus on the US dollar index. And as long as the Federal Reserve keeps that US dollar index where it is, right around 95, 96, I think that allows international exposure as well as some emerging market exposure to grow. And if you look at international compared to the S&P 500 over the last 15, 20 years from a timeline perspective, of course, US equities have actually crushed international. But I think it does make sense to reduce a little bit of exposure domestically and find a little bit of exposure in some of these developed countries in Europe, because they are about 6 months to a year behind us in every aspect of the word. But no, they're about 6 months to 12 months behind us in the COVID component. So I think it's going to be important to capture some of that reopening trade. But we are still concerned about the Omicron variant and what those ramifications are. I'm optimistic. I don't think it's going to have the effect like We saw the initial COVID-19 pandemic happen, but again, this is up for debate and time will tell.
So be able to move between value and growth, be equal weighted, add international, and don't panic on bonds that it's going to be a long time and a slow process. Would that be kind of what your premise is for?
That's fair. And if you could just step back for a second on the interest rate conversation, if the 10-year note does go to 2% or 2.25%, that is really healthy for tech names. If you think historically, the average of the 10-year note, which is closer to 5%, those are still really inexpensive rates for tech companies to borrow and grow. It's all about the velocity, Gilly. If we see the velocity of this 10-year note move from 1.45 up to 2.25 in a month, that's going to be problematic. But I think the Federal Reserve is going to really try and measure that and control that. So you're absolutely right. And I think being equal weighted, having diversification in your exposure. If you're lucky enough to have some concentrated exposure to Apple and Microsoft and the usual suspects in the FANG stock, I think it's great. But just reducing a little bit of exposure and finding some of the laggards, some of those tangible blue chip names we talked about, I think makes a ton of sense. You really have to understand what's in your portfolio next year versus, the 10 years after the crisis, you just kind of got lucky because the high tide did lift all boats.
Right. So you're positive in next year. You think
I'm positive. I'm optimistic. I'm probably more positive than most. And it goes back to that third head of the monster where I'm focused on the balance sheet of the Federal Reserve being a safety net. And of course, we're going to have volatility. I'm not being obtuse. We're going to see the VIX, which we like to utilize to understand volatility.
Right.
We just saw recently the VIX pop up around 30, did a round trip and tuck back under 20. So there's going to be volatility, but I think volatility allows you to find opportunities, and finding opportunities will be sector specific, country, continent specific, as well as understanding your weighting. Understanding weighting, I think, is really going to be critical in 2022. But I'm optimistic on the year. I don't think we have the same year in 2021, but I think the growth, the efficiency of companies that had to deal and survive during COVID, I think that will be translated into phenomenal earnings once again in 2022. And people talk about peak earnings. We hear peak earnings every year in earnings season this year, but I do think earnings season is going to continue to impress. And you're seeing a lot of buybacks too. And that's a telltale that we are optimistic about growth in our country.
So given all that, what's the one thing that investors need to be on the lookout for next year that might be that flashing red or at least yellow sign that all of a sudden says, hold on, we need to be extra cautious?
I get this question a lot on CNBC or other wonderful advisors like yourself. What keeps me up at night? And my first answer is my dog. My dog snores. But secondly, what keeps me up at night, Robert, is the fact that the Federal Reserve may be pressured to potentially make a policy mistake. If they are to raise interest rates 2, 3, 4 times, and they don't really have the economy on track, because there's dislocation in this recovery. There's dislocation from where you are in Texas to where we are in Chicago, where everyone's still wearing masks. There's dislocation in this recovery. So that's why I think the Federal Reserve is going to be more prudent, more dovish, allow more time for the economy to really get where it needs to be before they really raise interest rates. Now, if inflation does remain as hot as it's been, then that's going to be problematic, and that's going to force the Federal Reserve to raise interest rates 3 or 4 times. But I'm not in that camp. I think inflation does come down. I think people stop buying things with the feverish manner they've been buying things in COVID.
Right. Man, that's a lot of good stuff. Jeff, I can't say thank you enough for doing this with us. It's absolutely fantastic. It's part of the reason why we decided to go independent and join with Sanctuary Partnership and partner with Charles Schwab, is to be able to get access, one-on-one access to you, to get you the ability to talk to our clients. Thank you very much to everyone. I hope you enjoyed this, and we'll be in touch. Thank you very much.